Up, guys? It's July 25th, and welcome to week 3 of Q2 earnings season for 2022. So we got a ton of stuff going on this week. This is when it really heats up because we got trillions of dollars in companies reporting earnings that impact the health of the stock market this week. We're going to go over that, a couple of things that are going on in the macro environment. We got some Walmart news that just hit, and a couple of companies that I want to touch that reported last week to kind of get a good idea of the overall health of the economy and where we're at, okay? Before we do, of course, please hit that like button, hit subscribe. Definitely appreciate your support, okay? And hope you have some fun while we do this stuff, okay? Let's get to it. So here's today's action on the markets, okay? Very tame action today. Nothing too crazy. We got the Dow up about, 0.25%, S&P up about 0.1%, NASDAQ down almost 0.5%, Russell outperforming again. This is the small cap value stuff, guys. Over 0.5% on the day. We got the VIX down under 25 still, further down now under 24, touching that 23 level, and the 10-year bond yield under 3 significantly. Last time we talked, it was closer to that 3 level. Bonds have gone down since then, which means it's helpful to the stock market when that happens. But this also has to do with the outlook of a possible recession and an inverted yield curve. We won't go over that this video, but keep in mind when these bonds, the bond market moves in strange ways in comparison to the stock market, okay? We'll go over that later. Then we have oil under 100. That's where we want to see it. Hopefully under 95 sometime soon. And Brent still, that's the European price of oil, 106, okay? And today in focus, we want to go over earnings season week 3, all right? And we're talking about NABAF, okay? NABAF is not as bad as feared. We're trying to watch companies that report quarters that are not as bad as feared, and we're getting a lot of those, okay? This is the reason stocks have rallied since the lows in June, and I can tell you guys, just by looking at my phone here, I was looking at some information here from today on CNBC, and we can see the Dow Jones is up over 8% over the June lows, right, of the year. S&P up 9% over the June lows. Russell 2000 10%, and the NASDAQ up 11.5% over the June lows. So we keep showing some strength against the bottom, and we have to think, has the bottom been set on this market? I'm beginning to think, yes, it has. Even though we won't know for sure until we get support from the earnings we're going to hear from this week. Again, so we're looking for companies that are reporting quarters that are NABAF, not as bad as feared, and we're getting a lot of that, okay? We're also going to go over Whirlpool, who reported today, some Walmart news, American Express. I want to touch on that a little bit because that is very telling of what's going on in the economy. That they reported last week, and NXP Semi, a little bit, just a very short kind of explanation of what they reported on their earnings presentation today. Conference call doesn't happen until tomorrow morning, early in the morning, okay? As usual, follow me on IG, Twitter, and Discord. The links are here below, marked on the links on the comments. Now let's move on. We're gonna recap from last week's earnings, okay? And we had the banks report earnings. We already went over this on a prior video. The banks reported very, very strong earnings. Very well capitalized, very healthy. We got excellent credit quality, healthy deposit and spending growth, and remember, Bank of America said, hey, people were spent more in June versus May. June is the height of inflation, okay? We already know that inflation's going down, likely has peaked. I already made the call that it has peaked in June, and it will be going down in the later months. But it's kind of surprising that people spend more money in June versus May. That's kind of amazing, okay? And then last week, we had AT&T and Verizon. Completely different story from AT&T and Verizon, okay? AT&T saying it's taking 2 more days than last year to collect customer receivables. This means people aren't paying their bills, but I think that 2 days, 2 days more than usual is not that bad. But then you see that it cost them $1 billion for the quarter to not being able to collect their bills within 2 days of what they were able to do before. So pretty surprising there. I think that AT&T, quality-wise, is probably one of the lowest quality cell phone providers. I think my favorite is Verizon for dividends or AT&T for growth. Okay, we have Verizon saying, hey, the inflationary environment is clearly impacting customer behavior, and we saw intensified competition for consumer attention. These guys are always in a night fight for consumers. I mean, you see it every day on TV and what they claim as far as who has the best network and who has the best price against the quality of the network. These guys are constantly locked in a knife fight there, okay? We have both AT&T and Verizon. They're still spending significantly, though, on CapEx. That's capital expenditures, okay? That's 5G infrastructure. So they're telling us in their conference reports, hey, we're still spending money to build our 5G infrastructure because that is essentially the way to pave the future to get the most customers onto our network because we want to be able to be the most reliable network. In my experience, AT&T is not a reliable network. I used to have them. I switched to Verizon, who seems to be way more reliable than AT&T. So I'm very happy with Verizon at the moment rather than AT&T. I've never tried T-Mobile. Let me know if you like T-Mobile in the comments, okay? That's a pretty good managed company with good execution and good growth. I'm talking about T-Mobile, of course, okay? Now moving on to D.R. Horton. That's the home builder. That's America's builder. It says it right there on the logo. 53% increase in earnings and 28.8% profit margin, up 540 basis points up year over year. That's pretty interesting. With the slowdown of housing, it's very evident that housing has slowed down. They're still reporting an increase in earnings of 53%. Quite strong, okay? June showed moderation in demand and increase in cancellations. That's negative, but that's probably very normal with an increase in interest rates for mortgages. I should know. I'm a Rocket Mortgage a shareholder. Very, very difficult to be a shareholder of Rocket Mortgage at the moment, okay? They're saying, although demand has slowed from the frenzied pace we experienced over the past year, there's still qualified buyers in the market today as household formations continue and inflationary pressures drive rents higher. So they're saying, hey, the price of rent is actually a benefit for us because it drives people to be more on the buyer side than the renter side, okay? 54% of homes we closed in the past 12 months were priced under $350,000, and our average sale price is approximately $100,000 lower than the average other public home builders. Pretty good to hear that, specifically because they're catering to the lower end buyer of homes, which is good to hear that they're seeing strength. They're seeing strength in earnings, okay? And of course here they're saying, hey, there's construction delays plus supply chain issues, and they delay home construction, causing a decrease in future guidance. So they're saying, hey, we're not going to do as good in the future because we have supply chain issues and we have problems hiring people to build these homes. So that's when that labor shortage comes into play. That's part of their supply chain. They need labor in order to build homes, and labor is hard to come by because people have options nowadays. The labor market continues to be strong. We've talked about this in prior videos about wage inflation and the strength of the labor market. That strength is still very evident, and D.R. Horton is reassuring that for us, okay? Now, a pretty nice quarter here. American Express with a triple beat. EPS revenue and revenue up by almost $1 billion. And they raised their guidance on top of that. That's called a triple beat. When they do EPS, revenue, and guidance beat, that's amazing. That's a reason to buy a stock, okay? Then we have revenues up 31% year over year, reaching a new record high thanks to record card member spending. Now we have some kind of common denominators here between the banks and the credit card companies, right? Pretty much showing the same thing. Good strength to the consumer, good level of spending being sustained, okay? If we're talking about recession, this is going to be a different type of recession, guys. Not the same as we've seen in 2008 or in prior years. This is going to be a completely different type of recession. I think it's going to be a very mild one if these banks and the credit cards are telling us, hey, spending is healthy and it is at record high. I know that it doesn't seem that spending money on a credit card is healthy, but American Express doesn't give a credit card just to anybody. This is no longer 2008 or those days, okay? We're talking about business revenue up 30% year over year, led by vigorous rebound in travel and entertainment spending. Wow, okay? This is what we want to see. When we look at an earnings report, words like vigorous are extremely positive. We want to see words like volatility or headwinds or things like that are negative, right? But we see words like vigorous, extremely extremely positive word to have in an earnings report. Okay, continued growth in goods and services as well. I think it's probably more services than goods, but American Express very strong there. Okay, and then new U.S. consumer platinum, Gold, and Delta card members were at all-time record highs. New credit cards being opened, great. We've heard about credit quality from the banks being excellent out there. American Express is going to be a good beneficiary of that, okay? And then they're also talking about customer retention and credit quality. Both remain exceptionally high. So very positive things from last week in these reports, guys, okay? Now let's move on. Now we're going to talk about something a little bit more negative. We're going to talk about Walmart. In the news today, they came in after the close and they slashed their profitability guidance for the year, okay? So they're saying, hey, expect EPS, that's earnings per share, to decline 8 to 9% in Q2. They still have not reported numbers in Q2, and 11 to 13% for fiscal year 2023. Whew, that's rough. That's rough, guys. So we're looking at the prior guidance, which was expected by only down 1%. That's a big decrease when we put these two numbers together here. 8 to 9% versus the 1% expected. That's a big slash in guidance. So, of course, the stock is going to see some negative action. Let's take a look at the stock real quick. So here the chart doesn't reflect it really well, but you see here down on the day only, 0.14%. But after the bell, they release these news and you're down 10% on the day from 132 to 118. Ouch, 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 ouch. Okay, so that's what happens when you cut guidance like that, okay? But when we go back to the reasons why, you have to consider that the retailers that got blasted last quarter by inflation were the ones that had the wrong inventory. We heard this from Target, okay? So Target told us, hey, we simply bought the wrong inventory for this change in consumer behavior, right? We're still buying TVs, electronics, Oculus Quest, all kinds of things that were in the back store that were no longer selling, that now they have to heavily discount. These were higher margin items, right, that were selling really well during lockdowns that are no longer selling that well after lockdowns when you get back to a more normal environment, okay? So management execution in question, right? Since we talked about consumer habits and change from higher priced, higher margin items, TVs, electronics, into lower price, lower margin items. That's food and other necessities, okay? So the news reflect negatively on Walmart and its shareholders. I mean, you see the stock price again, and you go, man, sucks to be a shareholder, okay? If we look at the valuation of Walmart, still pretty pricey. You have forward P of 20, PE of 28, but it's a $362 billion business. It's almost $500 billion, guys. So this is a monster. For it to drop 10%, we're talking billions of dollars in value. So it's a big negative thing on Walmart and its shareholders, but it's a huge positive for the overall consumer and the fight against inflation. So if you think about this, we're talking inflation, right? We're talking the prices of things going higher. When the prices of things like TVs, electronics have to be deeply discounted, you bet that has an outlook on inflation. The Federal Reserve will look at reports like this and make decisions based on what Walmart is telling them, America's largest retailers. And when they look at news like this, you best believe they are smiling when they see things like this, because it means their plan on lowering inflation is working. This little tidbit here is telling you it is working. So hopefully it works. But like I said, if you're a Walmart shareholder, sorry to give you these news, but it is what it is, guys. Execution. Now moving on to next week. Okay, we're already done with today, Monday the 25th. So this is all done. We're talking about NXP in a second here, and we're going to talk about Whirlpool in a second here. But we have tomorrow, of course, UPS and Coca-Cola, huge indicators before the bell. General Motors, GE, McDonald's, Raytheon, all important to the stock market. Tons of money here in the morning. And again in the afternoon, tons of money here in the afternoon with Google, Microsoft, and Visa reporting. I think this is probably close to $2 trillion in market cap after the bell tomorrow. So we'll keep an eye out for that. We have some energy company, Enphase. I like that company. It's actually a pretty good look into that one. Chipotle, Texas Instrument for semiconductors. These are lower end semiconductors. Nothing else interesting here. And we have Shopify and a bunch of different big market cap companies here. And Meta and Ford. Ford we own for the investment account. Meta we own in our retirement account. So we like Meta. We bought it recently in our 401k account. Very happy with that one. Qualcomm too, we own it in our retirement account as well. Okay, Teladoc is one that's owned in the public account, and the one that I show you guys. Don't expect anything here from Teladoc, to be honest. This is kind of like a really long-term thing. It's a Kathy Wood stock. I don't expect you to buy it or to do anything with it, but I do believe in the future of telehealth and their initiatives when it comes to mental health. I do believe in those, okay? And then we have Lam Research for semiconductors, okay? And then what else? Apple and Amazon on Thursday. Wow. That's about what? That's about $4 trillion in market cap right there in those two alone. Just humongous. Intel, not too crazy about Intel. Remember, we like AMD. And then on Friday, ExxonMobil and Chevron, some energy names there on Friday, okay? For macro, or actually not macro, eco data, we have the Fed on Wednesday expecting a 75-point increase on the interest rate. That's the expectation. Nothing by surprise there. It shouldn't take you by surprise if they go 75 points. I think it would surprise me if they go less, to be honest. But I think 75 points is going to be the norm there. And GDP numbers on Thursday. Expect to hear a lot of talk about recession when GDP reports on Thursday, when we're talking about consecutive quarters of negative GDP growth equal recession. You know, at the end of the day, that's a really old way to kind of signify what a recession is or to define a recession. But, you know, let the news call it whatever it is. We just take advantage of good price stocks, well-priced stocks, while they're well priced, not when they're expensive, okay? Now, a quick tidbit here on NXP. This is their second quarter results here that are posted on their investor relations sites. I'll go over this more in detail on a dedicated video for NXP, but you can tell here that 27.6% year-over-year gain in revenue is just amazing, okay? They're saying here, hey, look, $3.31 billion this quarter, increase of 28% year-on-year. That's above the midpoint of their guidance range. Outstanding. Notwithstanding the clear macroeconomic cross currents, of course, everybody's talking about those headwinds or cross currents. NXP continues to perform well. Customer demand within the auto, this is the reason we own the stock, the auto segment, industrial and IoT end markets continues. IoT's Internet of Things continues to exceed our incrementally improving supply, even as we risk adjust our long-term orders. New design win commitments are remarkably strong across our focus end markets, which underpins confidence that our investments are well aligned with the long-term market requirements. Okay, so again, increased 28% year over year in revenue. Yeah, great. They're still paying a dividend. They're still buying back shares, and they have free cash flow of $551 million. Outstanding. Very good quarter for NXP, even if the stock sees negative action, which I think it saw a little bit of a negative action, nothing too significant. I'd be a buyer of NXP on more weakness, most definitely, okay? Now let's close it out with Whirlpool. I'll go real quick over Whirlpool, okay? This is, of course, you know, refrigerators, dishwashers, washers and dryers, electronics, you know, for the home, okay? And then they have an EPS beat by 68 cents. That's very positive. Okay, that's good. That's not as bad as feared. Revenue miss of $140 million compared to $5.1 billion. I would give them a pass on that. I would say that's not as bad as fear, okay? APS is down $1.89 but versus the all-time high record of Q1 2021. That's about a year and a quarter ago, but it's still up 86% and 70% over the prior years. Outstanding, okay? And they're saying this was among the top 10 strongest quarters in the history of the company. They still expect a strong second half. They're still increasing the quarterly dividend. Just extremely strong statements by their CEO as far as the health of their business. And this is a major company that trades really cheaply. To be honest, this is dirt cheap valuation when it comes to Whirlpool. But at the same time, this is a company that will trade at a low PE because it doesn't have all this amazing growth in front of it, okay? It pays a phenomenal yield of 4.25%. Phenomenal. So for dividend investors, this is definitely a very safe play for you guys. I think Whirlpool is a winner as far as a dividend investor point of view. Okay, now that's going to be it for today, guys. Let me know if you guys have any questions. Hopefully I can be of help. Please feel free to reach out. IG, Twitter, Discord, links are below. Peace out.